This is a Barita podcast, which is a medium for information purposes only. This podcast is not a recommendation to buy or sell any securities. This isn't a research report, nor intended to serve as a basis for making any investment decisions. Contact a licensed investment advisor before making any financial decisions. Let's get into the Barita podcast.
Welcome to another episode of the Barita podcast. You can see former episodes at barita.com/podcast. All right, so we are joined today by two of Barita's finest, Richardo and Daren. Thanks very much. All right, so right at the top, you can just introduce yourselves quickly and say what you do at Barita.
Go ahead, Richardo.
All right, thanks, Daren. Richardo Williams, AVP for Investment Research and Portfolio Advisor, or Investment Strategy, rather, Portfolio Advisor.
And I'm Daren Mcgegor, Head of Investment Research and Portfolio Advisory.
All right, great. So let's get straight into it, guys. In terms of Barita's 2023 investment outlook, right? How do you see things? You know, just give us an overview, and then maybe we can spend some time talking about what happened in 22 and why it happened. But right at the top, tell me your views.
All right, sure. I mean, in many ways, what we're seeing in 2023 is a continuation of the key themes in 2022, which is elevated inflation. And what that means is the expectation for continued interest rate increases across most central banks. So interest rates are likely to remain higher for longer. Because inflation has been particularly sticky. In other words, it has not come down at the pace which we anticipated. You know, those who are in quote-unquote team transitory. Inflation has become a bit more permanent or structural, right? We also need to add to that the continued geopolitical backdrop. Those are likely to actually escalate in 2023. In fact, we're seeing a lot more discussions and talks or concerns about what is happening in the geopolitical space, particularly what could eventuate between China and Russia, and the possible ramifications therefrom, the continued impasse between Russia and Ukraine, and there is also a potential conflict between China and Taiwan that is happening out there in Southeast Asia, right? So when you take all of those into consideration, the possibility exists that should any one of those geopolitical factors blow out, it could actually have ramifications for inflation, which becomes more structural, and consequently it flows through to your expectations for interest rates, right? So in a nutshell, Raul, hedging my answer to you, it's we are walking a tightrope in 2023, and it means that we're expected returns are concerned. Skilled investment managers can still harvest some of that volatility, particularly in credit markets, because you are seeing the possibility of getting north of 5% on some almost risk-free assets just now, without necessarily taking on extensive duration. In other words, a lot of interest rate risk by staying short, right? So we have that on the credit side. Equities, some sectors still remain fairly attractive as well. And of course, the commodities space continues to perform, albeit at a halting pace as compared to 2022. So that in a nutshell, I think, is how we're seeing 2023 shaping up.
Okay, I mean, so the world is a dangerous place.
Not sure.
Right? So I mean, you spoke a lot about inflation, you spoke a lot about interest rates, right? So just because you did, it was a rough year for stock markets generally last year, right? So 2022 was rough. Are the twain linked in terms of the higher interest rates and the higher inflation? Do you attribute that as a driving force to the negative performance of stock markets in 2022?
In some respects, yes, because if you just do what you call an attribution analysis, just see what were the primary drivers of returns, and let's just take U.S. equities as an example. Then you can definitely draw a line from interest rates to the actual returns that you received, because most of the returns were driven by tech stocks last year, on the downside, I should say. But you also would have fared pretty handsomely if you had exposure to energy, because energy stocks did fantastic last year. And you could have done an all-weather kind of approach, which Buffett actually did, and beat the market by about 22%, right? So what I'm giving is a more nuanced perspective. So yes, while you have the degree of causality moving from interest rates to a particular return that you saw in equities, if you played the market right, you could actually get positive returns. The mechanism that exists that links interest rates to, say, equities, for example, in particular tech, is so we call like your equity duration, because you usually think of duration in fixed income, right? The sensitivity of your cash flows to movements in interest rates. A similar thing obtains in tech, because many of these so-called unicorns, their cash flows are so far out into the future. So it means any change in interest rates will make their prices far more sensitive, right? And that is essentially what happens. So increase in interest rates, those prices kind of plummeted. So there's a significant degree of equity duration there. And then closer to the year, when there were some talks about maybe the Fed backtracking, you saw that tech started to perform again. And year to date, 2023, that is kind of the same thing. That is happening, which is not necessarily a good thing, because we might be seeing the building up of a potential short squeeze, right?
Yeah. So just to add some color to that, so in the current environment, what we face now is a potential for an increase in real yields in the near term, as the Fed continues to hike interest rates, and you have that expectation of interest rates moderating or coming down in the near term. And there are a couple of sectors or industries that tend to perform well during that environment, in line with what Richardo was saying about duration of these. So he had mentioned technology, which tends to perform poorly in such an environment. That's one of the industries that you kind of want to underweight. Another such example would be media and entertainment, materials, industrials, where you do want to skew your portfolio towards in this environment are sectors such as financials, energy, consumer staples, healthcare, utilities as well, which, and again, going back to the structure of their cash flows, these tend to be more stable businesses. Their cash flows are centered more closely to the present, right? So they have less of that, longer duration exposure relative to tech and some of these other sectors, which are, more sensitive to the business cycle.
Okay, all right. So thanks for that. So there's a lot there. We talk about equity duration, right? And the thing is, I figure you're speaking more about your typical tech startup or unicorn that has profitability or free cash flow way off into the future, right? But the mega caps, they have very strong cash flows, right? And they got crushed. You know, it's your Amazons, your Facebook, the Googles of the world. They got crushed last year, right? And I want to come back to the why, but what I'm trying to nail down just to start is 2022 was a difficult year for investors generally.
Yes.
US stock market, Jamaican stock market. Well, Jamaican main market, right? US S&P generally for the bond market. Why?
Yeah, I mean, there's no one particular reason, right? And which is why in answering you, I referenced energy, for example, and I also referenced say how Warren Buffett's portfolio came out. Yeah, you know. So what we're saying is to determine the causality, you have to look at the primary factors, what we know. One is that coming into 2022, no one anticipated that the Fed would have increased interest rates at the rapid rate and pace at which it did, because the Fed, even though it did not say it explicitly, by its own actions, it demonstrated that they were behind the curve, meaning that they took too long.
Catch up, right?
And as we saw, it is the pace at which they hiked. It was one of the fastest in modern history, right? So that obviously will work its way throughout the economy. Analytically, when you're calculating like your expected returns and so forth, at the base of that are your risk-free rates, so forth. So to the extent that interest rates are, and this is for all asset classes, right? So in a simple way, if you have your cash flows in your numerator and interest rates in the denominator, this is for all asset classes. Once your interest rate begins to go up, right, and let's say your cash flows in the numerator remain the same, then the resulting value is going to come down, right? Which are your prices. So that is why your S&P, your and your bonds, which is pretty much the typical asset class that you would use to motivate this example, that those prices fell as well. Once the cost of capital and the economy begins to increase, then that is going to have a downward impact on your prices. Now,
we just encapsulate that.
Yeah.
We refer to a hurdle rate, right? All of us watch track and field, right? So it's a hurdle, right? Is it fair to describe the policy rate's impact on the hurdle rate that we use to value assets as essentially pushing it up and making the hurdle higher to jump over?
Yeah, man. Because that is how modern economies work. The central bank's policy rate basically sets the tone for every other rate in the industry. It's cost of money that is in the economy.
So is it fair then, Daren, if I'm summing all of this conversation up so far, to say that the Federal Reserve had a historically fast pace of interest rate increases?
Correct.
Right? And then that kind of, more locally, the Bank of Jamaica was obliged to follow that in a sense.
I would not say obliged to follow, because the BOJ actually moved first.
Okay.
Right.
All right, fine. So, but in summing it up, we had rapid interest rate increases in the US, rapid interest rate increases in Jamaica. And is that the single, if you had to pick out the most important factor for what was downward pressure on markets, right? both equity markets and bond markets. It would you look at that as one of the key driving forces?
Yeah, that would be one of the key driving forces, and it's not really just about the magnitude of the change, but you have to also look at where interest rates were coming from.
Yeah.
Right? So, I mean, interest rates were coming from, a range of 0 to 0.25 on the US side. You had treasuries yielding below 2%, so these are brushing against,
that's US government debt.
Yeah. It's brushing against some, lower bounds from a historical standpoint, right? If you start from that position and then you raise at the fastest pace or among the fastest pace, historically, you're going to have a big dislocation there, right? Because everything is priced for, rosy future, Another element of that is when you have inflation increasing, but you have that lag of interest rates catching up, which is what happened in the States. Inflation on that side, I think it really starts to take off in about June of 2021, right? But you didn't have the Fed moving until March of 2022. So between that time...
Team transitory, right, Richardo?
Right. So within that time, what you had is a situation where inflation is going up, rates are not really matching that, right? So real returns are coming down, right? And where you look for that real return relative to fixed income securities are equities. So equities became a lot more attractive in that period of time, which at least partially explains, a lot of the escalation of the price to earnings ratio that you would have seen during that time. And of course that's reversing now as we get to an era where the Fed is a lot more serious about their interest rate policy and, really ramping up on that side relative to inflation.
Okay, so inflation is what necessitated the move in interest rates.
Correct.
Right? By the way, Richardo, in defense of team transitory, the Fed missed the inflation target for 10 years. So I don't know I just thinking if I was on the board in June 2021, I'd have probably let it run as well. In terms of, when you see the whites of the eyes of inflation, the first signs of inflation, you kind of let it go because you've been falling short for a decade. I don't know what you think. Reasonable?
I mean, I suppose.
We don't want much of team transitory too much, in retrospect.
But there were some very credible voices who were in stark contrast, I would say, to that, whose voices I believe didn't get sufficient airtime, like Larry Summers, for example, and they turned out to be right.
I don't know. I think Larry gets a lot of airtime. Whether they listen to him or not is another story. But
what I just also want just one final point on this, just to make it very, very, very clear on why central banks had to increase rates, is that quite a bit of them, just like our own, are what we call inflation targeters.
Yes.
Right.
Yes.
So if you take Jamaica as an example, you probably you hear this a lot in the media, that the central bank is increasing interest rates and so forth. It's because they're legislatively mandated to do so, right? So if they have a 4 to 6% target band for where inflation should be, if inflation comes in on either side, that is above the 6% or below the 4%, the central bank governor has to write to the Minister of Finance explaining why and so forth, and they're obliged to take action to get inflation back to 4.6%, between 4 to 6%. Whether you use your policy interest rates to address a supply shock kind of inflation is a different argument altogether, right? But they're obliged to act.
Yeah, we won't have that debate today.
Exactly.
but so in some, a core function of most modern central banks is price stability. So if prices start to accelerate, then they're compelled to move.
Yes.
Obliged to move, and interest rates is their primary tool, right? So thinking about last year and the lead up to last year, is it fair to say that we had a pandemic, we had historic monetary and fiscal stimulus, right? The U.S. central bank cut rates to zero. The U.S. government sent checks to almost every adult in the country. So historic stimulation of the economy, and then we had prices start to move higher, right? In the wake of that, and as the economy reopened, then we're hit with a war that supercharges inflation. That's a fair sum up of the lead up.
Sure.
Then the central banks react aggressively, and we see a very tough year in 2022 for stock and bond market investors. So that's what happened, right? Okay. So seeing that happen and coming now to 2023, if I'm an investor, Jamaican stock market had been doing so well, right? 2018, 2019, I'm feeling good, right? I'm hoping maybe I can even retire by 40, right? And then I come to a rude awakening in 2022. I want to know, what's 2023 looking like from, across all asset classes? Like, Daren, how are you framing that up, and why have you come to the conclusions that you've come to, looking at 2023 and looking at investor options?
All right, so pre-COVID, we were in an environment where you could be a bit less discriminatory and kind of get away with it, right? You buy the market, things go in your direction, and you can kind of sleep at night. Going forward from here, it's going to be a lot more important to be more discerning and a bit more selective on where you deploy capital, not just across broad asset classes, but within those asset classes.
Okay.
Looking at what sectors that you allocate to, right? So in looking at the fixed income space, right, we face a few broad overarching themes, right? So we're still leaning towards the upside with the Fed and their interest rate policy, right? What that means for the bond side is that you don't necessarily want to have too much of that corporate duration exposure, because again, that's more sensitive to
corporate duration exposure, just long dated bonds.
Yeah.
Okay.
Because of the sensitivity to increases in interest.
So what kind of time span should I stay within? 3 years, within 2 years, in terms of the bond maturities?
So lower duration, you're looking at below 4 years.
Below 4 years. Okay. All right. Continue.
Right? Yeah. And to be fair, on the treasury side, relative to the corporate side, you're a bit safer there if you're looking at longer duration.
When you say treasuries, you're talking about US treasuries? Okay.
Right? Because again, on the corporate side, you have some of that added risk from the corporate side. So if a recession does materialize in the coming year or in 2024, those corporates relative to US treasuries are going to underperform.
So you expect spreads to widen in a recession, corporates over treasuries? Is that what you're saying?
So in a recession, yes.
Okay.
Spreads will widen, and looking at where spreads are now, they're not historically wide, right? So on the IG side, you're looking at around 120, 130 basis point spread on the IG side, which is on the lower end, right? So you're not within the realm of what would be considered cheap, right? If you want,
so you feel like investment grade bonds are fully valued right now, or fairly valued? Is that what you're saying?
Pretty roughly valued.
Okay.
Which is why you can't just allocate broadly to investment grade bonds and set it and forget it, right? You have to look within the space and see where the pockets of opportunity are. Now, if we get broadly to, above 200 basis points, that's where, in general, it starts to look a bit more attractive. It tends not to stay above that level for too long, unless there's, some form of credit event, say 2008, 2009, where you're looking at over 600 basis points, but that's a specific case, right? So again, within this environment, if you're looking into investment grade corporate bonds, you want to skew shorter term, right? Be mindful of the industries that you're allocating to, and I would have touched on some of them earlier within the environment that we face.
So, just reiterate it. What kind of industries do you like?
Yeah, so again, those non-cyclicals, the consumer staples, healthcare, energy, because of what's been happening in that industry. Prices, the price environment is a bit more favorable. Those companies, they've used the increase in profitability to really shore up their balance sheets from a leverage standpoint. So they're not really investing in new capacity in a heavy way, right? The regulatory environment in that space is also still pretty adversarial, if you want to put it that way, to energy companies. So longer term, you're not really looking at any major above trend increase in production capital capacity, particularly in the oil and gas space, right? Which bodes well for the future of the price environment, right? Which again will filter back into the cash flow of these companies, which at this point are setting themselves up for a more favorable leverage and solvency position, right? So that kind of underscores the favorability of that space and why we see some opportunities there.
Okay, so I guess we'll get into scenarios before, because if for argument's sake there's a counter offensive that materially reduces Russia's production capacity, then you might, because you mentioned capex is not very big in the energy space, but if we face acute supply shortages that might run for some time, that might change, right? So I guess we can look at different scenarios, but thanks for that, because we have to have some kind of base case. But Daren mentioned recession, right? Now, from what I remember, coming into the new year, Q4, December, it seemed like everybody was calling for a recession, right? The Bloomberg model had 100% probability of recession, which I personally thought was extraordinary, right? But Richardo, what happened? I mean, January at least, the price action was very positive. Labor numbers were strong. Inflation seemed to be moderating, right? The US consumer looks strong. And all of a sudden, the narrative now, what I keep hearing is soft landing. So talk to me about, what happened in a month. Did Christmas come in January? What exactly went down? Yeah.
The thing about the economy is we are not just looking at brick and mortar, so to speak, right? Every economic decision, there's a human being behind it. No matter whether you want to deploy however many machines and systematic strategies and so forth, there's a decision to be made. And George Soros has an interesting theory about the reflexivity of the economy. In other words, and it's not as highfalutin as it might sound, because even Jay Powell, in one of his pressers last year, made it as a very important point to say that what is different this time around in terms of how they're pursuing monetary policy and how it has been absorbed in the economy is that the economic agents are actually absorbing the information much quicker, that's one.
Yeah.
And two, and acting accordingly. So it's almost a self kind of fulfilling thing that's happening. So if you think about it practically, if everybody is saying recession, think about yourself and me. I can't give you, I always begin with the first person singular. I'm saying, boy, I don't know what this year is going to be like, so I start save up. Certain things, I become more judicious in my choices.
Yes.
So okay, do I really need this in terms of my spend and so forth. So what it means is that it is not surprising actually that the economy has evolved in the way that it has, because what you will find is that persons who are underwriting loans in the financial sector, for example, would have become more stringent in terms of their credit standards. And you see that coming out. For instance, in the US, they do a survey of their senior loan officers. They will tell you that given these concerns, they are becoming more judicious. So some of the excesses start to move out of the economy, and therefore, by virtue of telegraphing this recession, it's like the heaven is falling, sky is falling kind of thing. It never does come, right? So it will breed some kind of stability. But there's a danger there. Again, another interesting economist, Hyman Minsky, he has this quip to say that stability breeds instability. So it is not that the recessionary conditions have gone away forever. They have really just been as sort of deferred, right?
But how long does stability?
You can.
One second. On that, how long does stability have to be stable to breed instability?
Well, I mean, if you knew the answer to that, Raul, no recession would actually. Right? It comes entirely out of left field.
Yeah.
Right, and we came very close to having one of those events. If you remember, the liability-driven, which that is some of the pension funds that almost blew up in the UK, right? So if their central bank was not in a position to jump in and essentially pursued a massive QE, then I'm sure the conversation we're having now would be very, very different. Right, it would have been right because we're talking about a serious magnitude, and we don't know the degree of the exposure that those pension funds have to asset managers all over the world.
But then, a core function of central banks is lend a last resort, right? So I mean, they did what they're supposed to do. Right?
No, they did what they're supposed to do. But the point that I'm making is that nobody saw
that coming. It's a black swan type.
Precisely.
Gotcha.
Right, and that's typically how recessions.
Which, by the way, is why I was skeptical about the recession cause in Q4, because I'm saying this would have to have been the most predictable recession and most predicted in modern history.
But that's the point that we're making. It is so well telegraphed
that it doesn't happen.
The behaviors
changes.
I guess. Right, and so it has deferred somewhat, right? Which is not to say that say in 2024, because this is where quite a bit of the expectations is right now for the slowdown to kind of start really manifesting itself, because we have to take into consideration the deep inversion of the yield curve. Now, even though it's very dangerous to say this time is different, but there's on the one hand the argument that the deep inversion we're seeing now is because there is a scarcity of high quality liquid assets, so to speak, right? And therefore you are seeing significant demand, particularly the long end of the yield curve for these assets. And there are a number of reasons why that is the case. So even the original founder, quote unquote, of the yield curve recession link,
is it batting 100%, by the way?
Almost, because the 3 months 10 year has done 6 out of 7, which is
it's pretty high
in our area. That's right.
Legendary,
much better than economists
who have what, with their 2 hands.
But anyways, right. So the point is that is still in play, right? And I don't think, and this is the important point I want to get across, right? This is not necessarily because it didn't come when we expected it, then you should become complacent. All right, in terms of how you allocate.
I definitely want to get to your base case, but I see Daren dying to come in. You had a point to make?
No, really just to come in with a supporting point. So again, what we have to recall is that throughout the pandemic, again, we have to remember all that stimulus that came into the economy, right? So what you saw over that time is that household savings went up almost vertically, right? And there were two main spikes that in 2020 and I think 2021 as well.
Sorry, on that point.
Yeah.
Household savings, and it's unreal. The chart, last chart from memory, June 2022, normalized figure was like 800 billion, and as at June 22 it was something like close to $5 trillion, right, in terms of cash sloshing around in US households. The point is, and whatever the numbers are, the point is, it's not,
the move up was almost vertical.
Yeah, and it was, but it's not just vertical. It was like significant. It was factors higher than anything that's normal.
Correct.
Right. So suffice to say, U.S. households are quite well endowed,
Yeah, and
financial worth.
And of course, that's going to feed into consumer spending, which is a big portion of the U.S. economy, in particular. So, and we're still having some lingering effects of that. The savings rate is coming down now, so I don't suspect that this is going to be pushing into 2024 and sustaining it in that way, right? But that kind of lends towards some of that explanation on the sustainability of the high growth that we've been seeing recently, particularly in the US, right? Because again, stronger than expected consumer. There was also some fairly good outcomes on the investment side, on the net export side as well, particularly in the last.
Oh, you mean real fixed investment? When you say investment, what you mean?
real investment.
Okay.
So, as well as the net export outcome, particularly in the last resort, that also acted to support GDP in the US, which again is expected to come down at the global level. Based on the last IMF World Economic Outlook, we're looking at 2.9 next year relative to I think 3.4 expected for 2022.
That's global GDP.
Global.
Okay.
Right. So we're seeing things come down as the impact of the tight monetary conditions and the conflict in Russia and the Ukraine, as well as the potential risk with China as they work through their issues with COVID and balance that with the thrust towards reopening going into the rest of 2023 and 2024.
All right. So all that being said, James, what's your base case expectation for the first half of 2023 from an economic point of view? So the recession is pushed off, but you're saying let's not be complacent. Inflation remains elevated. Interest rates have been increased. So on those big macro variables and the macro economy, what is your base case expectation?
Good.
I mean, I would say we are pretty much aligned with the most recent World Economic Outlook from the IMF,
which says,
because if you notice, Daren just said it was 2.9
for 23
2023, which is actually a revision upwards.
Correct,
from their October 2022 report. So they have become a little bit more sanguine about how they see things in 2023, and there are two primary drivers there. One is that China is being quite aggressive in terms of its stimulating local demand. As you know, China is a large market for world's
everything.
Exports. That's one. And two, we were expecting a fairly harsh winter in Europe, which would have kind of exacerbated their energy crisis there. That did not materialize.
The opposite happened, right?
Pretty much. So on those two primary fronts, the IMF anticipates that will give a little bit more fillip to world economic growth in 2023. But we have to caveat this clearly that we can't see much farther than half year,
yeah,
and things can change
so
very quickly.
Okay, so the outlook, the base case has been increased. 2.9 is below trend or trend, what you know?
Thereabouts.
It's about trend growth. Okay, so
below trend.
So the base case is maybe a touch below trend growth. The base case has been revised upwards on the back of Chinese reopening and a European mild winter. But so Richardo, the US consumer to me is kind of like the elephant in the room, right? So what is our view on the US consumer, especially in the context of the fact that the US labor market, the job market in the US is clearly very strong, right? We saw things like Social Security payments were increased almost 9%, like 8.7% this year, right? That's 70 million American consumers essentially getting a raise, right? And retail sales have come through very, very strong. So given the January data, right? I don't know if 1 month does not a trend make, but given the January data, is there any upward revision in what we're expecting from the US consumer and therefore the US economy?
Well, let's say yes. Let's agree that on the face of it, the US consumer balance sheet is fairly healthy, right? Certainly as compared to what obtained just before the last global financial recession in 2007. So that's one. But we have to be a bit more nuanced in terms of what the headline figure actually represents and how that number is distributed across, I suppose, social groups, right? So we're talking about issues of equality or inequality here. And it is an important consideration because in the last FOMC set of documents, a couple of the Fed governors made the observation that even though household balances appear elevated, they are concentrated pretty much among more wealthy households. Right?
Sorry, when you say FOMC, you're talking about the rate setting committee of the Federal Reserve?
Of the Federal Reserve, right? Federal Open Market Committee, right? So that is not an inconsequential observation.
The inequality of the resource distribution.
Because if you say the consumer household balance sheet is $100, just for argument's sake, and there are 100 consumers, and if 20% account for 80% of that 100, then clearly any kind of slowdown that comes will have a disproportionate impact on the 80, right? And one way that we can kind of test that is just to see how consumers are actually funding the retail sales report that we saw yesterday, which was
it's close to a 2-year high, right?
Right. We're seeing credit card balances skyrocketing, even though household savings are coming down. So that, to me, when you sparse it, again tells me that you need to be a bit careful in what you infer about the strength of the U.S. consumer, the U.S. or the balance sheet.
So you're saying the U.S. consumer
and layoffs are actually starting, right?
Layoffs,
right?
Yes. Really,
particularly in the tech sector, right? It is an important consideration, right? Because if you are expecting earnings to go down
in terms
across
of
the
wages,
economy, right? one of the first things you're going to start doing is cutting your existing job openings. Once you do that, then the next leg to go is actual jobs.
Job cuts.
Job cuts. I am not sure how far we are away from that, but
all right. So let's debate that a little bit, right? So we saw the tech layoffs. So Facebook, Amazon, some of the biggest layoffs in their history. But there's one narrative that's emerging that these are highly skilled workers that will find it easy to get jobs in what is a very vibrant job market. And as a matter of fact, it's good for the rebalancing of the economy because, you know, tech had come to dominate the economy. I mean, I think I heard one thing where it was like the hiring post-pandemic was like a factor of 3, and then for one company, and then they were cutting 20% or 13% of their workforce or whatever it was. So the point is they were still quite tight. So I'll submit the following points, Chad. We see tech layoffs, right? But those are highly skilled workers, highly paid workers that there's high demand for in other sectors of the economy. And as a matter of fact, when you redistribute those tech workers, you would tend to increase productivity in other sectors, right? That's point 1. And then point 2, the broader macro data is saying, I have a central bank chair saying to me that there are 5 million more jobs than there are people to fill them. I have unemployment at a multi-decade low. And I have a January jobs report at 516,000 jobs. So on balance, those are would seem to be diametrically opposed sets of data. So are you saying that the tech situation is a harbinger of a change in direction, or are we going with the macro data that would leave us more optimistic?
So I wouldn't go so far as to say it's an immediate harbinger of negative things to come in an immediate sense. What I will say though is that when you look at some of the coincident data points across production, income, employment, spending, we're not quite at recessionary levels just yet. Some of these points we are above trend, some slightly below trend.
What's below trend?
Below, say, the 5 year or so average.
Okay.
Right? Now, that's fine, but when you look at some of the leading indicators, when you look at for example, the ISM manufacturing and services PMIs, they're both pointing towards weakness ahead. When you look at the Conference Board leading economic index, that's also pointing towards weakness ahead. So while you do have that unemployment, brushing the lows, it's, again, you have to remember that unemployment is a lagging indicator. Yes,
it is.
Right? So it's kind of among one of the last things to really give you that confirmation per se that, things are getting bad or have been bad at that point, right? So the tech layoffs that we're seeing are certainly a sign, and I don't know if it's really the case that, we can lean on the elevated job openings in that way, particularly from a tech standpoint. I think it's more so concentrated in other areas of the economy, that excess of
so you don't think the tech workers are in high demand?
They are in high demand, right? But those openings that we're seeing, yes, tech is a part of it, but it's not really where the main force is. It's more so you're looking at healthcare, you're looking at retail trade, you're looking at a lot of some of these service areas that would have seen a particularly bad hit during the pandemic. Because if you're working as a waiter during the pandemic, you lose your job or you get furloughed or something, you're probably going to find something else to do in the meantime, and that doesn't mean that when things open back up,
you're going to go back to being a waiter. Yeah.
Right?
Yeah.
So there is that structural dislocation. And as well, based on what's happening from a health standpoint, there is more demand for healthcare workers in that way. So again, these are some of the areas that are really seeing the job openings pile up, right?
Okay.
So yes, it may point to or be a sign of some emerging downside on the employment side, but I wouldn't use the snapshot of where we are now to say that things are going to stay that way on the labor and employment side, and by extension the consumer spending side.
Okay, I
just a point here, because in your opening, right? So the point of our conversation really is to say, okay, to our listeners, you can really make money.
Yeah. Yeah.
So what is the actionable thing out of what you have just said? And there's a parallel between what you have just outlined and the same kind of what we call adductive reasoning that your doctor goes through when you visit. Mm-hmm. So when you go to your doctor, right, they ask you a number of questions. You're feeling a pain in your belly, you're feeling a number of this and blah, 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 right? And based on the number of symptoms that are present, then they look for one kind of explanatory factor. What might explain all of these symptoms that I'm seeing? So to relate that to what might that one explanatory factor be, our inference that we can draw from all of what you have said here. And that inference is that things are a bit stronger and better than they ought to be from the perspective of the central bank.
Okay.
If the central bank perceives that the labor market is stronger than it really should be, and therefore the inflationary impulse is going to be much more elevated than it really ought to be, then the logical inference here is that interest rates are going to be higher for longer. That is what we really can abstract for our listeners. If that is the case, then what are the implications? So it goes back to our opening discussion about the relationship between interest rates and your expected returns. So going forward, we're going to see quite a bit of volatility. So it really isn't, from an investment perspective, yes. From an investment perspective, it really doesn't matter, quote unquote, whether persons who are laid off from tech find employment in hospitality and XX. What really matters is what the policymaker will do, which is the central bank, and how asset markets are going to play that. The possibility exists, just given that, the possibility exists that, and they have already signaled it anyways, that rates are going to be higher for longer. The question is, how do you play that in your investment portfolio? And some of the ways in which we have been trying to do so is, as Daren indicated, you have to look at reducing your duration exposure. That's one play that you can do in the fixed income space, right? Short duration, investment grade. So that's one. Two, and this is where, persons like our fixed income portfolio managers here at Barita this is what they do. You can get into more sophisticated strategies to say, okay, as the passage of time goes, as we go further into 2023, and the inflation fears give way to more recessionary fears, right? Then you expect the yield curve to kind of start steepening, right? It may or may not happen. So what you do, you hedge your bets. So you take some exposure at the long end of the curve, some exposure at the short end, which means that you're betting on the spread between those two yields, right? The yields at the long end, the yields at the short end, right? That those are typical and well-established strategies that you can use in the fixed income space at this stage of the cycle. So a way that you can probably play that is to look at our fixed income unit trust here, because those are some strategies that we can explore. The third factor that we can think about just to play this environment is that 2020 was very interesting from a if you are interested in investments beyond just making money, but you actually like what is actually driving it. We saw a reversal in the typical correlations between equities and bonds, right? In terms of their correlations, typically you would have equities going in one way, bonds going the other way, so they're negatively correlated, right? What we're seeing now is basically a new regime, if you can call it that, of positive correlations. So they're going in the same direction, which is a nice way of saying investors have nowhere to run for cover. So we have to imagine and innovate and think about alternative ways in which we can find positive returns given that regime. So factor investing in the fixed income space is one such. So what you can basically do now is to look at credits. Could be credits that are in a specific economic sector on which you have a strong conviction and you allocate in that sector, right? And you can do that through a number of ways. It could be a fixed income ETF that takes exposure to energy companies or energy credits that are at a particular stage in the energy complex. Could be an energy company that does both EP, that does distribution, whatever the case is. The point that I'm making is that there are these three strategies that we can explore at this stage of the cycle if we expect central banks to continue maintaining a fairly restrictive monetary policy. So that would be our response to that question of what the macro variables are saying and how that actually impacts on the decision that you can take for your portfolio.
Okay, all right. So I'm gonna switch gears a bit and probably propose something else. So, I mean, we spend a lot of time on macroeconomy because of the importance of inflation and interest rates and everything that we spoke about, right? I spend a bit of time on the US because of the old adage, America catches a cold, Jamaica catches flu, right? They're the largest trading partner, they're a dominant economy in the world, and we have proximity to them, right? So, if we come down now and look at the Jamaican setup, right? So we spent the time on the US, and I mean, at the very least, US is stable, right? From a economic point of view, maybe moving forward. There's a whole debate about the interest rate policy, because given where inflation is and where interest rates are we really restrictive? I don't know, but maybe we'll have that discussion later on or another time. But when we look at Jamaica, right, we saw where the same story, 2020, significant pandemic economic contraction, right, somewhere in the order of 11% plus. As the economy reopened, right, I think the IMF's numbers were north of 8% for 21, 22, and then they're expecting 3.5 to 4 for 22 to 23 fiscal year, right? Which brings us back pretty close to where we were pre-pandemic. Now, from an investment point of view, with that hole that the pandemic had created, the main market, if we're talking about stocks, Jamaican stock market has struggled. Now, the junior market did better, right, as the economy reopened. But if I look now, trying to kind of diagnose that duality, right? If we look at why the larger cap stocks have struggled. I mean, if you presume that the hole that the pandemic created was a drag on those, right? Junior market, smaller stocks like more nimble and could capture the uptick on the reopening. But from a macroeconomic point of view, Jamaica has proven, I think, significant resilience, having come through how we've come through with the pandemic. And if we look at the big numbers, your debt to GDP numbers, you look at the reserves, etc., you feel like, okay, we have debt to GDP that we expect to be below 80%. We have ample reserves. We feel like we have proven macroeconomic management credentials if we look at how the pandemic was navigated. There seems to be pockets of value in the main market. Is that somewhere, within our outlook that we'd want to look and diagnose for me a bit why the market was pressured? I know financials have a high weighting there, and we saw what happened in terms of higher interest rates and financial markets creating fair value losses. Was that a driving force into what has been like a weight on the main market, and how do you see that evolving going forward?
Yeah, so when you look at the main market, and as you said, rightfully so, the financials are very overweight as far as their allocation within that index. So the main index would have been down around 10% last year, right? But when you look within the index, right, the average decline of any given stock in the main index was about, call it 2%, right? But that really points towards the impact of some of these mega cap financial stocks. NCB in particular would have been one of them, down up more than 30%, right? So it's really a function of the skew of the performance of some of those larger exposures within the market, right? And again, it goes back to our point I made earlier about looking within the market at the various sectors that are likely to perform better in this environment, and looking at the financial sector, what you're gonna find is that they're likely to be pressed on the net interest margin, which is one of the major income line items of the financial stocks, right?
Is that because of higher interest rates?
Because of higher interest rates. So what you're gonna find is that on the interest expense side, you have shorter term financing moving up higher than the income from the interest earning assets, which are on average going to be longer term and reset at a slower clip, right? So your income is a bit more fixed in its interest rate, but your shorter term expenses are repricing at a higher clip faster, so that's going to compress your net interest margin. Coupled with that, what you're going to have is, again, some pressure on the gains on, say, marketable securities, and based on what's happening within the market, right? So you're going to be pressed there, given the volatility in the market and, again, the tight monetary conditions. So there's going to be less opportunity to take gains from securities, right? On the capital market side, it's going to be, it's going to be a mixed bag, but there will generally be some challenges there, right? So for the financials broadly, you're looking at a bit more challenging environment than, say, for example, the manufacturers, or in particular those that offer, say, staple products, right? So, for example, to throw a name out there, if you look at a Wisynco, they're more likely to have a easier go of the current environment just by virtue of the products that they offer, and the impact that the broader economic climate is likely to have on their business, right? They offer staple products. Things are bad, you're going by water. Things are good, you're going by water. And again, some of the other products that they offer as well, that they distribute. Yeah. Secondly, where you want to look from an opportunity standpoint are companies that have some exposure overseas, whether it be through growth in exports, or if they have an operation overseas. So, for example, you look at JBG, big contributor to their growth in recent years has been their U.S. operation.
That's Jamaica Brothers.
So again, that extends their growth potential beyond Jamaica, because Jamaica is only so big, right?
Yeah.
And you can only sell so much chicken in Jamaica. So that, and again, with what they're doing with the discontinuation of their Haitian operation, it frees up their operation to focus on more profitable areas of their business. And when that discontinued operation impact passes, right, you're likely to see that filter through to higher net income in a major way, right? We look at Wisynco exports, well, not this quarter, but over time they've had some quarters with triple-digit export growth, and it's a high potential area for their business, even though exports is still small as a percentage of their revenue in the current in the most recent quarter. Added to that, they have some pretty ambitious capital expenditure plans that will position them for increased production capacity going forward, which is among the most significant investments that they've made recently. So again, they're positioning themselves for growth. You've got companies like Massey also positioning themselves for growth, focusing on their core areas where they have competitive advantage. Very active in the M&A space. GK as well, also very active in the M&A space. So again, companies like that, they still within this environment, they do have those opportunities to grow, right? If you look at the last GDP numbers for Jamaica, manufacturing was year over year 9% plus. So we're still seeing some strength there within the local space. And again, the headline figure was also strong at more than 5% as well, right? So that's still a pretty strong area to look at locally.
So you think there are definitely opportunities in the main market?
Yeah.
Right. Okay. All right. Thanks for that, man. Richardo, in terms of what's the baseline expectation for 2023 for both Jamaican GDP and inflation?
Well, I mean, if we go by the IMF's recent Article 4, we expect growth of about 3%.
That's pretty high for Jamaica, right?
But I think some base effects are still
in there,
probably there. That's from a growth perspective. And in terms of inflation, the expectation is that we should end financial year 2023-24 at about 6%. So in other words, it should come back
to target
the BOJ's 4-6% range.
The reason I ask is because, I mean, we had the whole conversation about inflation and interest rates, and then Daren, you mentioned financials are kind of a special case when it comes to main market, right? So the question is, if we have continued above trend growth and at the same time inflation stabilizes or comes back to target, does that bode well for the financials in terms of the main market opportunity set?
What I would say, Raul, and just to backtrack to your first question a bit, it's very important that our listeners appreciate what moving from a debt to GDP ratio of 145% to about 79, right?
Yeah.
It's very critical
to
understand what that means. Because what it means is that when you have such a high debt to GDP ratio, ultimately what it means is that the government is through its borrowing activities crowding out private investments, right? And therefore your capital markets will not grow. But when you have 70 something debt to GDP. Still fairly high, but for us, that's
huge.
a monumental accomplishment.
Yes.
I remember we spoke about this in summer of 2021.
Yes.
We have some bragging rights about just this is the fruits of the institutionalization of economic governance.
Yes.
And that always is a tailwind for the performance of risk assets, right? So to answer your question specifically now, given that background, and remember, this is a forecast, by the way,
Yeah,
so it
so
don't
it's
have
subject to,
but based on the run rate, if everything continues as it is now, that is where we will land, right? It therefore means that you're right. It might mean that you see a reversal of the spread compression that we have been seeing, to the extent that the central bank backtracks on its restrictive or high interest rate regime. So that's a positive for financials. But we also have to keep in mind that increasingly we have seen, certainly in the securities dealer space, fees and commission income accounting for a significant percentage of your net operating revenues over the last 5 years or so, because of large and small corporates tapping the debt capital markets, for instance, and raising funds through all sorts of means. The expectation is that with that stable macroeconomic backdrop, that could actually resurge. So you're seeing two particular line items there that could possibly be poised for further growth going forward. Your NIM and
there's also a feedback loop in that, because as you have more capital markets activity and there's a higher pool of assets, the asset management space,
pretty much so that is the point. Once you have a stable macro backdrop, it opens a panoply of opportunities. That is essentially the idea. And so the final point that I would probably want to impress upon our listeners is that yes, there are some things that are circulating in the space just now that might cause people to be skittish in terms of putting their capital to work. That's one. Two, we haven't necessarily seen the confidence really return to the market that was there from 2019. Right? We really haven't seen it, particularly among institutional investors and so forth. Right? So what we're seeing is that given what we think are some fairly attractive valuations still on the main market, and there might be a few on the junior market as well, and a stable macroeconomic backdrop, now is the time for you to be to be building up positions in these assets. We're thinking and speaking directly to investors now, right? Yes. Somebody who is into speculate and try to we can't know what but somebody who intends on building a portfolio to really generate wealth, now is the time to accumulate some of those assets. I mean, when we think about some really good blue chip companies trading in low single PE, we haven't seen this in a very long time. As a matter of fact, just before we saw these only in and around the time we were embarking on the first IMF standby agreement, right? And at that point, we were teetering on a fiscal cliff, right? Remember, there were anecdotes about when our politicians went into Washington. It's almost as if they had to go there on their knees because we were pariahs in the international financial community. And if the article we saw last week is anything to go by, now it's like we are now like we're going back into Damascus. we're being heralded in, right? So I think there is ample evidence for us to be cautiously optimistic about Jamaica's near-term and even long-term future, and we need to begin to put our capital at work because they are very good assets, attractively priced, and we need to be building positions in those.
So you're bullish on Jamaica?
I mean, I think I'm on record as saying that, Raul, because I am big on institutions, right? And we have made tremendous inroads in building the institutional foundations that will keep economic governance anchored, right? So we're talking about the whole introduction of fiscal rules, for example. So there can't be no ministerial discretion. Again, that's a thing of the past. We have a central bank that is independent, right? I know people will have different views about perhaps their current posture and that kind of thing, but at the end of the day, it is very interesting that a central bank can stick to its position without any fear of political meddling, that kind of thing. That's a hallmark of a strong democracy, and that's critical for capital markets to grow and evolve, right? So those are things that you keep in mind if your mindset is about building durable wealth. You need to have those things in place to ensure, because it will give you the full knowledge that your wealth is secured in a strong institutional foundation. That's where we're at.
All right. So if we sketch out a base case or that scenario, I'll just fire off some things and just find out what you think about them, right? So I hear you saying that Jamaica is and the main market in particular offers some selective value opportunities, right?
Correct.
That we should definitely look at. Institutional strengthening means that we have a good framework, a solid market setting. There's some anecdotes to pile on top of that. So when I hear talk of significant, say, public sector wage payments, that to my thinking, that's economic growth positive. So I'd be interested to hear. So when you talk about the compression of debt to GDP, to the extent that enables the government to spend less on servicing the country's debt and then spend more on building its infrastructure, these things are economic growth positive. So these they add to the case that Jamaica might be interesting at this time. And then of course, if we look more regionally, Guyana seems to be quite of global interest, right? And they were, I think, the fastest growing economy in the world last year. So when we frame that up, just close out for me. You already spoke about the main market, spoke about fixed income strategy. Barita is big on and by the way, Barita capital growth is a interesting way to play the main market.
Yeah, man, right? Exactly. Yeah.
And Barita is big on its alternative investment platform. So just talk to me a bit about everything that we've said thus far. How does that play into the alternative investment platform, and what are you expecting?
So we have articulated in various quarterly reports and our annual reports, I think, what we mean by alternatives. Alternatives, it can be
broad. It's very broad.
Wieldy, all right? Yeah. And so I think the most demonstrable aspect of our alternative investment strategy as far as what we have been doing in the real estate space. So we have significant greenfield and some brownfield assets that we are going to develop along different thematic lanes, right? And again, it is inescapable for us. It is inescapable. We have to go back to that stable macro backdrop, because when you are pursuing real estate, the way you account for that in macroeconomic accounting is you call it your gross capital formation. It's quite literally you're putting things down in the earth, right? And when we track or gross capital formation, if you just graph it from the 1960s, and you would see that it had a precipitous fall in the turbulent 70s, for known reasons.
Yes.
People are pulling out capital and so forth. And consequently, the nature of the investments that we have been seeing up to recently has been more capital markets, like paper investment, so to speak, because you can easily sell that and leave, if right?
But really, if you're committing, right?
Exactly, that is the point. And you don't commit unless you know that, well, the institutional environment is strong. So really, that is a critical anchor and a critical consideration that is driving our alternatives thrust in real estate. And obviously, private equity is a big part. And I think we can probably acknowledge that is something that is right across the industry now. Everybody is doing some version of private equity, which I think is very good, right? Because I think the pie is expanding, and there is enough for everybody. So that's another critical element of our alternatives thrust. But the final thing that I would say, however, which is a limiting factor, is that the other leg that we have to work on from a macroeconomic perspective is our productivity.
Yes.
So absent productivity, much of the gains that we're making now might not amount to as much as it could have been if we solve for that productivity.
So, I want to kind of crescendo on that point, Richardo. There's been a lot of hard work done in Jamaica, right? You're taking debt down from 147%. If the projections are to be believed, you're going to be 79.7, sub 80%. That's 67 percentage points of GDP. Massive, right? No wonder the Financial Times refer to it as Jamaican economic miracle, right? So the thing is, though, because you made an important point in terms of productivity. We saw years of austerity. We saw a hard-fought debt reduction. We saw public sector wage freezes, right? We saw a lot of hard work. So the question is, and we had a pandemic that kind of distorts things in the middle there. But the question is, are we coming into the promised land, Richard? Like with all of this work, and this is my genuine question. We've had a growth problem, right? We've had a growth problem for a generation. We see 8% and we see 3.5%, but there's a pandemic recovery, so you wonder about the distortion. Two-part question. One, all this work that we've done with the macro that you lauded and you spoke to, have we increased potential growth with doing that work? And it seems like the plan to raise productivity is long-term education, investment, and so forth, right? And hard infrastructure investment. So, have we increased potential growth already, and are we on a path to continue to increase potential growth? So as an investor looking on Jamaica, can I expect a better growth outturn than I've been used to for the past generation?
I would say yes.
Say cautiously though.
Yeah, and why I'm cautious is that obviously these things take time, right?
Yeah.
William Easterly called it the elusive quest for growth. So it's been a long time that we have been trying to accomplish some semblance of growth. So it will not be accomplished overnight. right? So the same kind of policy focus that we have taken to fixing the macro, we have to kind of take it to the social now, because that is where I think the limiting constraints are. Because there are estimates of the cost to growth from crime, for example, right? So if we can fix crime, quote unquote, I think we can easily add 2 to 3% to our real economic growth, right? And the government have signaled, various forms of investments that they're making. In that, from tech to training and that kind of thing, right? So that's 1. 2, the wages or wage reformation that they're doing in the public service, I think, is very important, to the extent that reorients the incentives of say public sector workers, and a proper kind of accountability system is implemented, in terms of making sure that targets and that kind of thing, because it means that you will probably start attracting good talent there as well. Because, I don't always like to refer to the Singapore story, but that is widely well known. That is one way in which they have achieved the kind of growth that they have by attracting the very best in their public service and compensating them at that level. So I think we're at the early stages of trying to solve for those more intractable problems that are limiting our economic growth.
Okay. So again, you're cautiously optimistic. So let me just try and pull it all in. So
just one other point. What basically, because we're talking to everybody here. So it's not just about somebody who is buying assets on the various indices, right? It could be somebody who is contemplating to a business, a business venture, and so forth, and you're really wondering about what could this economy look like 5 or 10 years or so. So to those kind of individuals, we're seeing that Jamaica is not what it once was, certainly from an economic perspective. And we're making, I would say, the right strides.
Okay, so you think Jamaica is more investable today?
Pretty much,
for sure.
Yeah.
All right. So if we pull all of that in, it's fair to say we think the US in the near term will remain stable. We're not expecting that economy to fall off a cliff, right? So given that, and given the work that has been done in Jamaica from a macro point of view to reduce debt, to increase reserves and increase institutional fiscal management, right? And we didn't talk much about it, but unemployment figures look good in Jamaica.
Yeah, 6%.
Right? So given all of that, the work that has been done and the work that is ongoing, and as Richardo said, Jamaica being a more investable jurisdiction, the values, the single digit PEs that we see on the main market now become compelling, right? So we like that and of course, Barita capital growth is an efficient way to play that, but also single stock investing might be worth a look with your advisor given where we are, right? And in terms of from a fixed income point of view, we probably want to stay limited duration, right? And you probably want to avail yourself of skilled investment managers to navigate that space, right? So I think that's a fair sum up of where we are. Go ahead.
To add to that though, I think it's important for investors to remember that investing is a long-term pursuit.
Yeah.
So I think it's very common for the development of some degree of short-term fatigue in the market when you buy something and you're not really seeing it move in a month, 2 months time, and get some type of fatigue out of it. But you have to remember that there's substance behind what you're investing in. These are businesses. These are, they're
Operating entities.
exactly,
Yeah.
right? And you have to ensure that when you get into these investments, you understand why you got into them, which goes back to, that discussion that is good to have with the advisor, right? So understand why you got into them. Understand the long-term prospects of the business that are going to drive whatever expectations that you have of the business, right? And over time, evaluate whether those factors have changed. What is happening with the key driving factors of the business, right? If things are getting better, but you're not seeing the price move yet, what that means, it's more likely to be an opportunity for you to pick up more rather than to say, well, things not happening now, let me sell some.
Patient, yeah.
Right? So, and when you look at the main market over time, you really see this play out, because what you will see is bouts of stagnation and then triple digit returns, in very short spans of time.
So you don't want to miss it. Right?
So you don't want to miss that, and you don't want to be fighting for those returns when everybody else is trying to pile in as well, right? Better you take a long-term approach, a structured approach to investing over time, rather than say, well, let me try time the market, sit on some cash and wait for when the stars align and things are right about to take off. Because when that time comes, you may not be getting the same opportunity set that you thought you may have had.
Okay.
Right.
All right. So, again, like just summing up some of the things, if we continue to make progress in Jamaica and continue to increase our growth potential, the US remains stable. The Jamaican entities that are market leaders locally and have overseas assets, particularly, like US assets, you mentioned Jamaica Broilers, that's an entity that you like, right? In terms of destination for investment, for new capital. That's fair, right? You mentioned Wisinko, efficient operator and market leader again. So again, if we continue on the trajectory that we expect, then that would be another entity that we would like. If markets, and this is, I kind of see this as a X factor, if markets stabilize or we get the immaculate disinflation, right? that has been bandied about. If we have a situation where central banks do not have to tighten financial conditions further, right, where they can, even if they remain elevated or stay where they are, and we see financial markets reprice without turbulence, am I hearing that the financial sector could be quite an outperformer if things turn around in a positive direction, right? So
I do think some of these larger cap financial players are attractive long term. It's just that in the short term they face some intermediate challenges, right? But long term, they do represent fairly attractive growth platforms.
Okay. All right. Well, so main market has value. Jamaica is investable. Consult a skilled manager to help you through your fixed income strategy.
Yep,
fair?
that's it.
Fair.
All right, gentlemen. Thank you very much.
Thank you, Raul.
You've just listened to an episode of the Barita podcast. The Barita podcast is available on all Barita's social media platforms. If you would like to invest with Barita Investments Limited, visit our website at barita.com or contact us at 876-926-2681 to get started.